little while since I uploaded a video. A few days at least, I think, since the last one went up. I do know I am coming to the conclusion, or I have come to the conclusion, that if I want the channel to grow a bit more, I need to be more consistent with my uploads, but very, very difficult currently with where I am in my life. Got a young baby under 1 year old, so as this is not my full-time profession, I couldn't think of the word then, profession, then spare time is hard to come by, and anybody who's been in the situation where you've got a young baby will understand your time is pretty much not your own, so you try and fit it in when you can, and unfortunately at the moment this one I can is not consistent enough, but there we go. Probably going to be a shorter video today as well. Basically want to look very specifically at one company which is up on the screen at the moment, but before we get into that, there's a few things that people should know. Basically, I don't know what I'm doing. I have no financial background and I hold no financial qualifications. This YouTube channel is simply me vlogging my educational journey towards hopefully becoming a successful investor one day. These videos are for informational purposes only and do not constitute investment advice. Any opinions formed during this video are my own and not recommendations, and they are subject to change without any notice. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions. So, with that out of the way, yeah, COTY, a beauty brand company. Now, I looked at this a while back. I got one of my earlier videos, one of my very early videos is COTY. So I'm vaguely up together with this business, but I want to figure out like when is it cheap enough, because there's some big brands owned by this company, but from everything that I remember they had huge debt overhang, so I haven't started any analysis yet, so we'll get into it. We'll just see if anything else has changed. Pardon me, if anything else has changed with COTY, and we'll go from there, because I didn't like the look of it because of the debt, but as with any value investment, sometimes if something's cheap enough, you know, it's the price, isn't it, that you're willing to pay for something. And if this business is to survive its debt problems, then the upside could be, you know, it's a very much, what I'm trying to say is it's very much a potential Monish Pabrai type thing, you know. Heads I win a lot, tails I don't lose much, you know, whatever it is that he says. So that's why I'm interested in this. I've got a funny feeling a large portion of the debt, they've got no lot, it's a lot smaller than it was last time I checked, but yeah, still free. They've 800 million they've paid off then since this time last year. And to be honest, it was probably around about this time last year that I last looked at it. What we will do is just try and figure out, I'll still ask my usual starter question, even though I sort of know what this business is. It's a beauty company. They own, well, is it Max Factor and Rimmel, and I'm pretty sure they do the perfume side of like Adidas and Gucci and all that sort of thing. So they've got some pretty big brands behind them, but a hell of a lot of debt. And there's also a holding company based in Luxembourg, but I think it's for a German family, Jab Holdings, that own a huge portion of this business. And they have historically, when debt problems have arose, bailed them out. Now the stock has got lower than it ever has done, you can see here. So whether or not they're going to this time, I don't know, but if it is a significant portion of their debt, of their net worth, then, you know, you'd hope that they would potentially step in again, but we're getting a bit too far ahead of ourselves at the moment. Is it COTY Inc? Yes, it is. we'll just see what we can come up with. What I haven't done as well is I got to get it in the spreadsheet. I'm not going to do the quick take spreadsheet for this. I'm just going to bang it straight in the spreadsheet because, like I said, the point of this video is to determine whether or not COTY is cheap enough considering the risks, and there are risks. So we'll just copy and paste this in to the relevant places. I have been looking at getting faster internet, so I might actually be able to make a spreadsheet where I don't have to copy and paste it all in. So, well, hang on, I haven't got the let's get the actual. There we go. Now everything should be. I'm not going to make the same mistake I did last time. For those of you who didn't know, I went on and on for ages about a business thinking that it looked really cheap on a few metrics, and then realised that I didn't have the correct stock price in it, so the market cap was all wrong, which is why it looked cheap. Right, so yeah, it's a tangible book, very low, negative obviously, but they own some big brands. Now, I'm not one that generally sees a lot in intangible assets, but I'm aware that they have worth, don't they? Coca-Cola's brand name has worth, McDonald's brand name has worth, so Rimmel and all that have worth. Max Factor, I think it's Rimmel, Max Factor, I could be saying them, it could be bloody wrong, but you know, in the beauty industry, their names, you know, there's a value to those names, so even though they are intangible, they definitely have a worth. Gross margins improved, look, over the last few years. It's down on a 3-year average, but it's better than what it was. You know, operating margin, I mean, severely negative for a while, and I say stable around 7%, but it is creeping down a little bit. Simple free cash flow margin, very poor here, look, very poor. When did this decline start? 2024. I mean, financially, it looks like the decline started long before that. What am I doing? Pressing the wrong buttons. Right. Yeah. Operates in over 120 to 130 countries. There you go. COTY models, own brands and licensed brands, fashion houses. Yeah, so Burberry, Calvin Klein, Gucci, Boss, Chloe, and others. So, product sales through wholesale, so they sell to retailers effectively, with some licensing royalties. COTY produces 81% of products in-house, mainly in the US, Brazil, and Europe. Distribution channels, yeah, everyone's been shopping, they know, they've seen these sort of products in there. Prestige fragrances, selective growth in skincare. Company's two main operating reportable segments: prestige, so fragrances, cosmetics, skincare; consumer beauty, mass market, color cosmetics. So what's that? Color cosmetics, what's that going to be? Makeup, I think. Fragrances, skincare. Yeah, so CoverGirl, Rimmel, Sally Hansen, Adidas. Revenue breakdowns. So the revenues are down. Let's have a look. And they are down. Yeah. COVID, that one though, so it's very difficult to take. The 3-year average is still up though compared to the previous 3-year averages. $6.50 in revenues a share. 30 cents. 34. Okay. Don't know what return on capital for. These are things we'll have to research because, like I said, I want to try and see what's going on. Grey, C double prime. Can't remember what grey means. What does grey mean? Grey basically means that it's up in the air, I think. Right, where were we? Let's start reading. 48% is in Europe, Middle East and Africa. 40% is in the USA or Americas. 12% in Asia. No single retailer exceeds 10% of global revenues. Pardon me. As you can tell, it's late again. Sales are seasonal, stronger Q2 holiday period. Figures are from COTY's, right. So, break down which brands are owned by COTY and which brands are licensed. Let's get an idea. Because they sold one of them a while back, I think. I feel like they sold Weller or something like that. Own brands, here we go. And COTY's 10k filings, to be honest, you could probably, like I said, you could probably look. Yeah, so Weller's gone, has it? Yeah, historical notes and stakes and others, e.g. past Weller stake, now largely divested, that's right. See, I remember they got rid of one of them. Partial ownership, so in the majority of Kylie Cosmetics. What's Kylie Cosmetics? Is that Kylie Jenner or is it Kylie Minogue? Kylie Jenner, right. It's horrible I even know who they are. So, right. Prestige, Jupe. What's Jupe? I've heard of Jupe. Skada. Just trying to get a German luxury fashion house specialising in clothing. Definitely doesn't look like clothing, does it? Everything's fucking scents. Did I read that right? Clothing and cosmetics, okay. I feel like I've heard of that Dupe Home. This one. What's on their website? Fuck off. Right. Okay. So it is clothes as well, look. Right, enough of that. Okay, licensed brand. No in filings, major prestige fragrances. These are heavily concentrated in prestige fragrances, a false and some consumer extensions. Top prestige fragrance brands, Gucci, Burberry, drive a large share of revenues and profits. So Burberry, Calvin Klein, Davidoff, Gucci, Hugo Boss, Marc Jacobs. These are all just ones I've heard of. Tiffany, Vera Wang, and others. Swarovski, Consumer Mass, Adidas, David Beckham. Right, additional notes includes regional favourites. COTY maintains 22 licensed brands as of recent filings. So not more than 22 here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 22, I don't know. Many long-term average 24 years. Many top ones not up for non-automatic. With many top ones not up for non-automatic renewal before 2028. What does that mean? With many top ones not up for non-automatic renewal. So is that just a stupid way of saying they're up for automatic they're automatically renewing? What sort of fucking grammar is that? 65% of revenues heavily reliant on licensed designer fragrances. Gucci, Burberry, Calvin Klein, Hugo Boss. Alright, dominated by owned mass brands. with some licensed fragrances. So the consumer section is basically almost all them. Prestige section is almost all licenses. Portfolio evolves through acquisitions, new licenses. Right. Which brands could relicense? How am I spelling it? Hang on. Relicense somewhere else the soonest. We need to look into the debt. Let's open this up properly. We might have to go to the 10K really to read about the debt. Well, that's answering that over there. Debt. Here we go. Oh, so they got senior notes, which means it's right on here. I'm sure I remember this from before. COTY. Right. 2030. What's HFC? Okay. What's happened here? Oh, fuck off. What's going on here? I gotta remember I found them all now. How did I? Is it on here? Oh, I gotta fucking log in. Hang on. Let's drag it down here. Off screen. Oh, I don't remember that. Right. Sure, I don't need to do that though. See if I can get it to work. Alright, what's going on here? Do. I am doing something off screen a minute. I apologise. Come on. Right, anyway. Don't want to waste the video doing that, do I? But we've got them all here. Look. We can ask ChatGPT about it anyway. Just drag this back a bit where it's meant to go. Right. 286 million this year, April this year. So has that been done? Long-term in the accompanying condensed balance sheet is the company has the ability and intent to refinance on a long-term basis through the COTY revolving credit facility. Recent developments. Repaid 250 million of the remaining 2026 using proceeds from the 2023 COTY revolving. Okay, so they've already done it. 286. They paid 285 million of it. So how much is owed on the revolving for a credit facility? Probably it's been going down two different rabbit holes there. Let's just figure out what's going on with the brand and then we'll go into the debt. Gucci is the clearest and most significant licensed brand that could and is widely expected to be relicensed or brought in-house elsewhere the soonest, with its license expiring in 2028. Originally, a long-term 50-year agreement is set to expire in 2020. Bloody hell. Following Kering's beauty partnership with L'Oreal, the Gucci beauty fragrance business expected to transition to L'Oreal will be managed in-house by Kering. L'Oreal Coty is publicly acknowledged it will optimize the brand during its remaining term, but will lose it post-expiration. Right. Okay. Gucci represents a substantial portion of Coty's prestige fragrance revenues. Estimates around 500 to 600. Wow. COTY's license agreements have an average duration, sorry, I'm just having a drink, 24 to 25 years. So if we are, wow, 5 to 600 million, what's the revenue? Just under 6 billion. There, so that'd be down to 5 billion. 5 billion on a simple free cash flow margin of around 4%. Let's put that in here now. 5 billion. $1.3 billion. We are at 1.8 now, so it's overvalued already. Like, fuck, you know. Alright. COTY's license agreements. Note the top 7 licenses, which drive 91% of fresh are up for non-automatic renewal before 2028. I see. Non-automatic renewal. None of the top 7 licenses. Average remaining duration for these is around 11 to 14 years, with some effectively perpetual or evergreen. Many licenses include automatic extension if minimum royalties are met or require mutual agreement sales threshold. Okay, public information does not pinpoint exact near-term expirations for others. Burberry, Hugo Boss, Calvin Klein. COTY keeps specifics confidential beyond the top 7, safe until at least 2028. Licenses, Lacoste license was sold back to brand owner. Newer expanded licenses, Marni Etros, are long-term by design. Owned brands are effectively perpetual ones that are not really licensable by others. Yeah, I get that. COTY's been proactive with renewals and extension for key partners. It is focusing on ultra-premium growth and new licenses while preparing for the Gucci transition. Rumours of portfolio sales or breakups have circulated but do not directly alter near-term license expirations. For the absolute latest and more granular terms, check. Right. So, is Gucci no longer classed as a top 7? That's what I said, wasn't it? It was top 7. No, Gucci is still classed as one of the top 7. None of our top 7 licenses are up for non-automatic renewal before 2028, with an average remaining duration of 13 years. Okay. So they've got 2 more years. I'm surprised they don't break it down, to be honest. So when did they say? Where is it? Right, anyway. Okay. So we know they're going to be significantly worse off. Significantly. Jesus Christ, this is a lot of debt. Right. There's a lot to read. Short-term debt. Long-term debt, 3.1. So, what is their cash balance? $270 million. So next year they're going to have to refinance as well. Let's just check a minute. How much Jab Holding owns. Where are we? What's going on here? View ad to continue. Alright, thank you. Jab there, 100% of Jab Beauty. But Jab, that's owned by Jab Holding, I think. So they own $1 billion. They're the only ones, and they're the only ones with a significant Flowers Food. I was looking at them recently. Don't get distracted, we're looking at COTY. Okay, so he bought 241, bought 200,000. Yeah, I've actually had a few purchases. Look, this is definitely all since I last looked at it as well. 392. I mean, they've all lost money. Okay. What can we make of COTY then? What can we see in it when it's at $2 a share? Historically trades at what? All over the place. Absolutely all over the place. 3 times, 4 times, 7 times. 7 times, 6 times. Oh. Just doesn't look cheap, does it? Nothing's materially changed since the last time. Nothing has materially changed. Debt is still a huge problem. Total debt, 3.5 billion. How much free cash flow did they make last year? 266 million. So they're not even close to... What did they say Gucci made up? Oh, I got a sneeze coming. A substantial portion of COTY's purchasing third largest fragrance brand. Third largest. So how do we figure that out? How do we figure that out? Segment reporting. Oh, we're on the notes here, aren't we? Segment data. Are they going to break it down even more? Probably not. Prestige. So what was there? 3 months ended last year. Okay. Okay. 9 months ended. 4.5. What's what they going to be around about? You'd think they'd be similar, wouldn't you? What's their historical revenues per quarter? I know they say Q2 is the best, but they're all doing about $1 billion and a bit. Q4 is the lowest then, is it? Historically the lowest. But in Q3, slightly lower year on year. So Q4 1.2. We're saying 4.5, another 1.2. You're probably looking at 5.7 billion. So revenues are probably going to be flat. See what they forecast. I reckon it's going to be around about flat. Oh, withdrawn it. Ooh, that's not good. Down 2%. Specs like-for-like revenue to decline by mid-single digit percentage. Mid-single digit. Oof. Okay, anticipated 6 to 8%. Decline 6 to 8%. No full year 2026 guidance currently in place. Expected to be neutral to moderately positive. Driven by business seasonality and disciplined working capital management. What are they doing to their working capital then? Let's see. Extending the payables. Inventory staying on the shelf slightly longer. And they're collecting later. So where is the disciplined working capital management? Company continues to target delevering towards an investment grade profile over time. Reported net revenues were the debt is a huge problem. Let's just copy and paste the whole lot in. Hopefully they can break it down. Where are we? Covenants, quarterly, and there we go. I'm just going to copy and paste the whole lot in and say, work this out. AI, do your thing. Show me what you're paid for. Right. Where are we? Here we go. There's a lot to break down. Break down COTY's debt and explain it. See what they say, because that is a lot of data. What's their interest expense? Interest coverage ratio 1.2 is very low. It's very low for me, that. Interest expense is TTM interest expense 220. Wow. What's net income? Minus. I might have to check that out. Why that's negative then, won't we? They're barely able to afford their interest expense, look. Barely. 60 million above it last year, only 45 million above it this year. Couldn't afford it that year. Couldn't afford it that year. Could afford it that year. What happened? Oh, I was working that out. Let's have a look at this. Start on the income statement. Oh, statement of operations. There we go. Impairments. Wow, they're getting whacked with impairments year on year. So, likewise, should mean goodwill's gone down. Yep. What else is there though? Asset impairment. Yeah. Even with the impairment, they're still negative. In this quarter at least. What's the 9 months? Okay, so they're not there. 9 months would be about 330 up. Then what's this other expense? Interest expense, other expense. So they're still down. Interesting. Right. There are senior secured obligations with guarantees from US subsidiaries, but many collateral and covenant restrictions have been suspended, released due to achieving investment grade ratings. 2 of the 3 agencies. Really? They can barely afford the interest expense. Breakdown maturity. Okay. Notes were fully repaid, redeemed. Yeah, but it's redeemed with debt. Optional with possible prior to specific early redemption dates. Revolving credit facility to the extent of the collateral. How much is the revolver? Is that on here? Gotta be on here. Let's have a look. I'll search this page. Revolving credit facility. Oh, fucking hell. Right. Company repaid approximately the remaining. Yeah, you keep repeating that, but I wonder how much is on the revolver. As a two tranches of secured, senior secured revolving credit commitments. So 1.67 billion available in US dollars and certain other currencies and other. Together, right, is that how much they can borrow on the revolver? Or here we go. Case of revolving credit facility. Nope. So, yeah. Okay, and now you've repaid it, but how much is on your revolver? 2023 revolving credit facility. With our revolving credit facility. Ugh. I don't know. Here we go. Net cash and financing activities. The increase in cash used in financing activities was driven by debt-related activities related to higher repayments and the proceeds from the loan. So he is in the billion. It is in the billions, right? Collateral release guarantee. Drawn as much amount as of March maturity. Up to 1.67 billion plus 300 million. So fucking 2 billion in a revolver. Used for working capital, layers of credit, temporary. Pricing is based on leverage of debt. Who gave him that? Total debt minus cash. Net debt adjusted 3.4, up from 2.7 due to seasonal factors. COTY remains focused on, yeah, but I fucking hate EBITDA. There's no capex in EBITDA. Charlie Munger always said, didn't he? If you hear EBITDA, think bullshit. COTY remains focused on further delevering towards an investment grade corporate profile, but how are they delevering if they're just using the revolver? COTY has materially improved its debt profile by extending maturities, lowering the average cost in some cases, and reducing total debt by 800 million. They have done that. We can see they've done that in the balance sheet. The structure is now more manageable with flexibility from the revolving credit facility. Okay, but how have they what do you call it? Decreased. Oh, spell it properly. Decreased debt when the debt was paid for by the revolver which in itself is debt. Part of one specific repayment was used, and here's a clear breakdown. A reduction of 792 million. Yeah, but how the revolver draw fits. Okay, so they only used it to pay off. They swapped one form of debt to another on a gross debt basis, so the revolver is flexible, lower cost, favourable terms. COTY reduced debt through a combination of external cash inflows and refinancing. Oh yeah, because they sold Weller, of course. COTY sold its remaining 25.8% KKR for 750 million. Jesus Christ, for 25% of the company. Right. Which company is bigger? Weller, Max Factor, Rimmel. Isn't it they own Rimmel? I think they do. In terms of brand recognition, Rimmel London and Max Factor among the best known. Weller is a stronger professional haircut. If you're asking from a business perspective, generally larger than either Max Factor or Rimmel brands individually. Alright, so COTY, Weller, Rimmel, because Max Factor. Weller was sold for 750 million for a 25 point whatever it was. What was it? Just try not to use up all my, if you wonder why I've switched, I'm just trying to not use up all my questions on one AI. What was it, 8%? Stake given the value of Weller, what can we discern about potential values for Rimmel and Max Factor? Oop. Standalone company or Rimmel and Max Factor are brands within a large portfolio. What proportion of Weller's sales profits and brand strength to Rimmel and Max Factor represent rough beauty industry approaches to value brands at 1 times to 4 times revenue? Rimmel's generally been the larger of the two brands. Max Factor has strong heritage but has lost market share in many markets and is no longer top tier. Weller's salon hair business tends to command higher valuation multiples. Okay. $20 to 50%, 600 million. Problem is, what do we know what percentage of COTY's revenues each brand contributes? Because I want to know if you were to sell them, what they would do to the cash flows. No, they don't. Rimmel is probably larger than Max Factor. Estimated. Can't go on estimates, can we? But right. What's their total debt again? 3 point summit. Even if you were to sell 2 of their large owned brands, they'd still have a lot of debt. It's all very well saying they delevered, but they sold. Right. Issued 900 million notes October 2025. Proceeds used to redeem the remaining mature extension refinancing, yet operating cash flow. I haven't even asked about how JAB fits into any of this yet. Improved significantly in prior quarters thanks to the Weller cash. Revolver drawn as temporary bridge finance. In summary, the revolver was used for one small big reduction came from the Weller sale. Yeah, okay. Right, I had another question in my head then. What was it? Have COTY put forward any other plans to cut their debt? Several ongoing forward-looking plans to further reduce debt and strengthen its balance sheet beyond their actions already, well as sale, bond redemptions, ongoing free cash flow generation. COTY emphasises using operating cash flow to pay down debt, particularly the revolver. Free cash was $275 million despite softer profitability, supported by disciplined working capital management. Right. What's disciplined about it though? Because they've fucking made it worse. Cost savings, 200 million cumulative savings. Let's have a look. With a broader goal of nearly 500 million in savings. Is that right? Let's have a look. There's only about 100 million there. Other expenses, 20 million, 60 million. What's that? 80 million, 140 million. I don't see in there. Alright. Improve margins. COTY is actively conducting a stringent portfolio review to unlock shareholder value. This includes evaluating options for parts of the consumer brute brands, e.g. mass potential actions, sales, spin-offs, partnerships, or other transactions. Sort of looking at Well Estate was a key example of this, yeah, but keep selling everything off and you're not going to fucking have many revenues left, are you? Reduce financial leverage towards 2 times EBITDA. Long-term achieve an investment-grade corporate credit for management linked successful execution of COTY. Gross debt has already been reduced. Alright. COTY expects to provide more details on the portfolio assessment in the coming quarters. These initiatives are designed to support both. Right, okay, so hang on then, what was my other question? What working capital management has been disciplined? Inventory is staying on the shelf longer by, is it DSI? Receivables are being collected slower by day sales of, was it? What's the fucking thing called? It's got a name in it. Day sales outstanding, DSO. And payables being extended by, was it 20 days? 60 days. Fucking hell. By DSP isn't always a good thing. It doesn't appear to be very what do you call it, safe long term. Problem is, you gotta ask, it'd be nice to have someone to be able to run this stuff by too, you know. Constantly got to run everything through ChatGPT. Positive year-to-date free cash flow despite lower profitability and revenue headwinds. Your concerns are worse than DSI, are valid and reflect real pressure visible in the filings and commentary as a breakdown based on the video. Slightly down. A common cash preservation tactic. This boosts cash short term, but carries supply relationship. Yeah, that's what problem. It's likely not improved, but net working capital changes still support positive operating cash flow. Yeah, but it's because they're not fucking. My management calls it discipline. Cash flow outcome matters most. Proactive steps, right sizing retailer inventories. Seasonality. Risks. You are correct. A sustained stretch in the payables is not indefinitely sustainable. Supply strain could lead to higher costs. Higher. Inventory efficiency and overall cash generation progress here will be key to discipline. Label is earned on net cash flow delivery, but underlying turnover metrics remain under pressure. So they're saying it's disciplined, but what they're really doing is pushing the payables out higher than what they have been since 2017. I don't like it when they do that because it's not. It's like sort of manipulating the cash flow, isn't it? Maybe like it or not, it is. What are they doing on stock comp as well? Fucking still paying stock comp like you can't believe. I'm not a fan of that. Days. No dividends, you wouldn't think there was. What's the share count doing? Up slightly. Oh dear, I don't know what to make of this. I still don't like it at the moment. $2 just still doesn't seem very cheap, does it? Alright. Let's ask. How do Jab fit into this? They own a significant portion, and Jab is 90% owned by 4 people. COTY failing will significantly affect their net worth. I'm sure it's owned by 4 people. We can have a look because I googled this at work the other day. Jab Holding. Where is it? Wikipedia. I'm sure it's like 90% owned by 4 people. Yeah, 90% of Jab belongs to 4 of the 9 adopted children of the late Albert Ryman Jr. Very rich man. So these are the other things that Jab own. Espresso House, they own 27% of Dr. Pepper, Krispy Kreme, Pret a Manger. I don't think Krispy Kreme's doing very well, are they? D-Nut. Someone was saying that they're not doing very well. I could be wrong. I don't know. I mean, if you'd have bought last summer, you wouldn't be too upset, would you, with a bloody return of 64% in the space of a year? Maybe we're looking at Krispy Kreme as well. What's Keurig Dr. Peppers? How do you spell Keurig? There goes KDP. They weren't doing great either, were they? 21%. So they own 27% of this. Right, let's have a look. Jab Holding is COTY's controlling shareholder with an ownership stake of approximately 52%, around 54%, including certain affiliated voting interests. Let's have a look. See who owns. Where is it? Ownership 55%. Who's the second highest owner? These people. 6%, and they are BlackRock. Of course they are. Fucking hell. Alright. This is basically all Jab. Jab's been a major investor in COTY for years, increased its stake and controlling level to 60% via 2019 tender offer, and has maintained majority control ever since. Older shares exert significant influence through board representation. Jab has driven leadership changes, made COTY's performance challenges, reflecting active involvement as a controlling owner. COTY is one of Jab's key beauty, alongside its much larger portfolio. Restaurants, Krispy Kreme. What's the fucking market cap for Dr. Pepper? Let's have a look. Market cap 43 billion. 43 billion times 0.27. 43 times 0.27. Oh, fucking hell. I was messed with. Because I've got two calculators. I've got a little boy and he's messed with. They own 11.6 billion of that. So they've got, not that they're going to right, but they've got things that they can sell to help COTY out if needed. But it sounds like they're fingers in the pie anyway. Yeah, I don't give a fuck about the impact if COTY were to fail. Okay, I already know about this. I don't need you to tell me about this. Impact of COTY is significant but not essential for Jab. COTY represents a meaningful but diversified portion of Jab's assets, and the management span tens of billions for heavy weighting towards coffee and food. Sharp decline in COTY's value would hurt Jab's net asset value hundreds of millions to low billions depending on valuation, but it would not bankrupt the family. Jab has shown willingness to support increasing its stake. However, recent moves, leadership resets portfolio, suggest pressure to fix or optimize the investment rather than unlimited support. Yeah, there we go. As controlling shareholder, Jab's incentives are closely aligned with improving COTY's performance to protect and grow their stake's value. Jab's controlling position gives them strong influence over COTY's strategy and turnaround efforts for the Ryman family. COTY is an important but non-core holding within a much larger empire. Failure would sting their net worth noticeably, but is unlikely to be catastrophic. So, recent moves suggest pressure to fix or optimize the investment rather than unlimited support. Right. So, honestly, then, at the moment, we're none the fucking wiser on COTY, are we? It still doesn't look cheap. They're going to lose 500-600 million in fucking revenues. They got no tangible asset value, so where is it? Where is it? This one here won't work. 151, 166, 40 times earnings. Fucking hell, that's on EBIT mine. Simple free cash flow 10 times. That's more than what it is now. I still don't think it's cheap, but could it be cheap if they turn it around? I don't really know what they're going to do to help the further debt reduction without selling something. I feel like they're going to have to sell something. The interest expense is fucking like 66% of free, no more than. I was looking at the other free cash flow then. To be fair, the reason why these ones differ so much is that I don't think this one takes out stock comp, whereas I take out stock comp on these. 83% of simple free cash flow just on the interest expense. Ooh. But does it get better long term? Is it a buy and hold? Heads I win, tails I don't lose much. You could lose $2 a share. Not that I don't think it's going to go up to these, but 2028, that's a long time as well, isn't it, to fucking wait to see what's going to happen post 2028. I think it's going to have to be just keep an eye on it again. Keep an eye on it and see what information comes out vis-a-vis the... I don't even know if we use that correctly then. See what information comes out regarding what they're going to do post Gucci. Right. Let's have a look. Oh, bugger off. COTY. Have they got any? Where's investor relations? Reject. Investors. News. Also, is there anything on here? Yes. COTY's refocusing on core brands. So no, okay, nothing. Do that same thing again. Trading view. COTY stock 12-month target raised to 319. Who's raised it? According to estimates, for analysts, stock average price target has risen. Really? From 1.5 to 8? Based on updated target implies approximately 59%, and consensus rate remains a hold across 17. Who's the analysts? That's something I think that they need to put in. They need to tell you who the analysts are. Same thing again. Undergone major leadership and operational transformation, integrating brand and innovation, reposition core consumer segments. Right. Final deadline. Investors face losses following companies allegedly concealing deteriorating trends. So what if they got another fucking national shareholder rights? Class action lawsuit has been filed. What are they asking for? What this means for investors. Devastating price common roughly. Doesn't say what they're asking for, does it? First quarter results met with positive market reaction despite year-on-year revenue decline and a miss on adjusted earnings per share. Management attributed the quarter's performance to a combination of ongoing inventory destocking by European retailers, weakness in the Middle East, and a highly promotional environment. COTY's shift from a sell-in to sell-out driven strategy prioritising actual consumer purchases over shipments to retailers. Companies also reported that while overall sales declined, brands like CoverGirl and Sally Hansen outperformed in the US in terms of unit volumes. Okay. Thing is though, it's very cyclical, isn't it? What people want. They might like CoverGirl and Sally Hansen today, but tomorrow they might not. I'll enjoy listening to ask about the duration of the sell-in versus sell-out gap. Quite about a timeline for retail destocking. Strobel said that the structural retailer destocking is mostly complete by aligning with sell-out, sell-in. I don't actually know what sell-out, sell-in is. Sell-out is the actual sale of those products from the retailer to end consumer. Right. Sales made by the manufacturer, wholesalers, retailers, distributors. Convince stores to stock your products and provide enough. Sales of the products by retailers. These two concepts: sell-through rate, which measures how fast a retailer sells the inventory they purchase from the manufacturers. You're trying to analyze your business. Okay, right. Nope, where were we there? Stray will explain that Gen X focus. Question whether a competitive environment could force price reductions. Denied plans to divest major licenses while remaining open to opportunities that create shareholder value. So they're saying they're not going to sell all the stuff off yet. Asked about the stage and impact. Okay. Looking ahead, we're monitoring the progress and closing the sell-in sell-out gap at COTY's sell-out focused strategy, the pace and effectiveness. Right, hang on then. Explain COTY's sell-in sell-out gap and what it means in simple terms. What COTY ships and sells to retailers. This is what shows up in COTY's reported revenue, what those retailers actually sell. Okay, difference between those two. It tells you whether retailer shelves are filling up faster than the products are moving off. Makes perfect sense. COTY's pushing more products into stores and customers are buying. This leads to retailer inventories building up. Retailers then order less in the future, which hurts COTY's future sales. When sell-in is greater than sell-out, what COTY's faced recently, and customers are buying products faster than COTY's shipping to stores. Retailers are drawing down their existing inventory. This makes COTY's reported sales look weaker than actual consumer demand. Okay, well that's good, isn't it? I mean, it's not good, but it is good. COTY's reported revenue is better than being the other way around, is what I'm trying to say. It's been weaker than its sell-out trends. Prestige sell-out has been roughly flat to modestly positive, while sell-in was more negative. Main reason for the gap: retailer destocking after holidays, promotional pressures. The gap has been more challenging due to weaker consumer demand. Persistent negative gap makes short-term financial results look worse than underlying demand. COTY's goal: to align sell-in with sell-out. We're focusing on fewer, stronger launches, better forecasting. Once alignment improves, COTY expects sell-in to catch up and better reflect demand. The gap is like timing mismatch between what COTY is selling into the channel and what customers are actually buying. Right, so what COTY ships and sells to retailers is the sell-in, and the sell-out is them selling out. Right, okay. What was the other thing I wanted to ask, and then I'm going to call it a night. What is this? What is their SKU rationalization plan? I'm guessing that's just to get rid of products and focus on more core, better selling products. Simplifying the portfolio, reducing complexity, improving profitability, and better aligning the supply of consumer demand. COTY's deliberately launching fewer new products and cutting underperforming and low volume ones. Course focus resources on hero products, trying to close that gap then, aren't they? They're trying to, the products that are in high demand and they're not filling the shelves fast enough, that's what they're going to focus on. Better inventory turnover, lower excess obsolete stock, focus on high impact. Right. Reducing the number of smaller launches. Improve forecast accuracy, stronger cash flow, short-term trade-offs, some near-term revenue pressure. This applies, but it's more urgent in the, what is that? More urgent in the challenge consumer segment. It's part of a wider effort. COTY's moving from a more is better launch heavy approach to a bigger bets on winners. Yeah, alright. Well, that's sensible, isn't it? That is sensible. So I like the sound of that. There's some positive things to like the sound of, isn't there? In that the revenues might be down, but the demand is there, and they're going to focus on the higher margin demand, I'm guessing. So there's positive signs. If they follow through with that, things could get better. And they need things to get better to pay down the debt. Is that enough information to make an asymmetric bet on it? I had no idea at this moment in time, to be honest. Right. Let's have a look. Who are COTY's competitors? That, because we need them to be floated, otherwise we can't compare them. COTY's competitors floated on the stock market. As I said, it's very difficult to compare if they're not floated. L'Oreal, Estee Lauder. Oh, they're not doing very well either, are they? Estee Lauder, but I've looked at them, but maybe that'll be the next video, because I have looked at. I'm sure Michael Burry's in these. Yeah, I have looked at them before. Look, when they were down here, fucking hell, should have bought, shouldn't I? I was literally looking at them when they were down here. And they're paying a dividend. What's the dividend? Let's have a look. 35, 35, 70. So $1.40. It's not high, is it? $1.40 to $90. It's not high. But, oh, fucking wrong calculator again. No. It's not very high at all, but it's still something. What was the other one? L'Oreal. What was their fucking thing? That one, OR. I mean, they both look better than COTY, don't they? Estee Lauder doesn't, but, well, not that it doesn't look better. It looks like it's recovering better. This video is quite long already, but and it's almost 1 AM. But I do want to put these in the spreadsheet, put in the comparison, just see what we've got. I said I'm sure Michael Burry is in Estee Lauder, and I'm sure it appealed to me as well at some point. Where are we going? Comp 1. Right, what have we got? Income statement, balance sheet, cash flow, cover sheet. Let's get this right. Comp 1, EL. Right, and then what's the other one? The only problem is you've got currency conversion in this, I'd imagine, because I bet their L'Oreal is in euros. OR. Not there. It is there, but we've got to try and find it. There we go. OTC, I don't want that. OR, there it is. .pa for Paris. Right, 2. In sheet. Oh no, cash flow. Right, income statement, balance sheet, cash flow, front page, or.pa. And let's just check. Yeah, in euros. Right. Comparisons. Why is that still saying Pandora? That should be. What is that? C28. Right, and then, because that's wrong. That should equal that. Boom. Right. 73% gross margin, so current ratio, better interest coverage. Whoa. L'Oreal's a much better company. Better gross margin, actual book value. Like actual book value. Return on capital is a huge. What is it then about Estee Lauder? That ain't the right price. Is it? That is not the right price. Is it? Is that the right price? Oh, it is the right price. What was it Michael Burry saw in this then? I know it was cheaper. $11 in book. No tangible book. You've got good. Right, let's see what we saw. No, because look at that. I'm sure he's in Estee Lauder. Simple free cash flow of $1 billion. What's its market cap? 32. Is that right? Have I got this right? That doesn't seem right. Yeah. Shut up. It's definitely right. 32 billion. I looked at. This doesn't make sense now because I'm sure I looked at Estee Lauder after finding out the Burry owned it and I saw something in it, but now. COTY. So what are they trading at? So has Estee Lauder got worse debt? Total debt, yes, it has miles worse debt. Okay. Need to put COTY over there, don't I? So they're all in a line. So COTY's trading worse on revenues, worse on book value compared to competitors, right? Its debt to capitalization is not as bad as Estee Lauder's. Its return on capital is better. Its gross margin isn't. Its free or simple free cash flow is in line with L'Oreal's. EBIT multiple to EV 14, 11 and 34. So it's cheaper than Estee Lauder. Simple free cash flow 19 times, 37 times and 15 times. It still doesn't look cheap, does it? But compared to its competitors, I mean, there's no point in comparing it to L'Oreal, is there? Because L'Oreal's a miles better company by the look of it. In a minute off screen, I'm going to ask what Michael Burry saw in Estee Lauder, because I can't remember what I saw in it. I definitely saw something in it. But now I don't know what, looking at the data, and I'm sure I read recently he's still in it, or he's put on his Substack that he's still in it. Right. I'm going to go away and have a think about COTY. I'm going to keep it in the think about it pile. Definitely something to think about there, isn't there? Right. Anyway, like and subscribe. Thank you very much, and I'll see you on the next one. Goodbye.